Okay, can everyone see the slide now?
Yes.
Okay, so we'll get started. So we'll start with a quick disclaimer. Basically, it just says that this information is just that, it's information. It's not intended as tax, accounting, or legal advice. Also that the laws can change at any time without notice. And this is based on what's known at this time and could change tomorrow. So what we're going to cover today, we have an introduction. We're going to cover some common tax deductible expenses, additional expenses for the fix and flip among us. And also we're going to cover some record keeping requirements. A few things we're not going to cover. We're not going to cover all types of businesses. We're focusing on real estate here. But we're not going to look at commercial rental. It's just residential. We're not going to really get into HST issues that can get very complicated very quickly. And we're not going to talk about trust and estates. So by way of introduction, my name is Michael Matthew. I've been a professional accountant for more than 30 years, and I provide the following services: assistance with US investments, entity structuring, so setting up companies, and both in Canada and the US with my colleagues, operational consulting, so helping people run their businesses a bit better, and tax planning, as well as tax return preparation and filing. Over the last decade, my international practice has increasingly focused on real estate and real estate investors at all levels, from single family to apartment buildings to a CFO position with a local home builder. I own a nearby condo rental property, and right now I'm looking for an apartment building in the US, initially in the Houston area, because of the greater returns that are available for less investment that are possible in the States. So plans for the group. Plan is to meet once a month, generally speaking, on the last Thursday, subject to holidays, etc., at 7 p.m. And I'll be delivering most of the content with occasional guest speakers. We'll address various issues related to real estate investing, including additional considerations for investors with US properties, accessing other allied professionals, whether you should incorporate your real estate business, etc. So we have two main topics for tonight. I'll pause for questions in between those two sections and after. So if you have a question, you can throw it into the chat as it comes up, or you can just wait until that point and just unmute yourself and ask your question. So the interesting thing about expenses is you're not actually required to claim any of them. The Income Tax Act requires you to declare every dollar of income, but you don't actually have to declare any expenses. Now that said, I don't know why you wouldn't, because you're going to end up paying a lot more tax if you don't. When you're converting your residence to a rental property, or vice versa for that matter, all the expenses that we're going to talk about, you can only claim them for the time period that the rental business was operating. So for instance, if you convert your primary residence to rental property as of April 1st, then you'll be declaring 9 months of whatever the expenses are. So first expense, we're going to cover advertising. So this covers the things that you normally think of, but it also includes online ads, for rent sign that you purchase and put out, anything of that nature. Automobile expenses. Now, this can get a little complicated. It comes down to whether you have one or more than one rental property. It's much more restricted if you just have one property. You're only allowed to deduct your automobile expenses against your rental property income if the property is local. So if you have a property in another part of the country, or if it's in the US, even if you're flying there to do things, that is not going to be deductible. It assumes that you're doing the repairs for your property yourself, and you have vehicle expenses to transfer your tools and materials. So it's a very practical reasoning behind the automobile expenses. What you cannot do is claim these expenses just for the purposes of collecting rent. If you have more than one rental property, the rules are more expansive. In addition to the previous reasoning, you can deduct your automobile expenses if you are collecting rents. Just supervising repairs, or just generally managing the property. So again, they're a little bit more flexible if you have more than one rental property that you're working with. To qualify for that, though, you have to have at least two rental properties distinct from your principal residence. Meaning, if you rent out your basement apartment and you have one single family detached home as an additional rental property, you can't deduct those extra expenses relating to anything beyond where you're doing the repairs yourself and you're transporting your tools and materials to the property. Now that said, for most people, I recommend you get out of the property management business as quickly as possible, and you let someone else do that, and you factor the cost of that into your purchase decisions when it comes to deciding what rental property you're going to buy. Next is capital cost allowance. This is probably the number one type of expense I see clients not having claimed in the past when someone else was working with them. What this is, it's the tax term that CRA uses to represent what's called depreciation. It simply can be thought of as wear and tear on enduring assets such as a building. What this allows you to do is to defer a portion of the income in your property until the year you actually sell it. When you do sell the property, all those deductions that you took for CRA throughout the years will have to be reported as regular income, provided, of course, that you have a gain on the sale of the property. Now, while you may not want to do that, the truth is, at the point you're selling it, you'll actually have the money to pay this tax. So I think it makes great sense to take the deduction and have to put out less cash during the time when you're not selling the property, and therefore not having, a big cash, a one-time cash infusion from it, and defer that until you actually do get the cash coming in. If it's a case where the rental property was or is your principal residence, it's generally advisable to not claim this deduction so that you can preserve 100% of your principal residence exemption for the maximum period allowed. So I think people have a good understanding if they're living in the house and they sell it at a gain, there's no tax implications because it's all sheltered by that principal residence exemption. However, what most people don't understand is you can literally move out of a property, rent it out for up to 4 years, and still claim it as your principal residence. Now, you can't double dip, so you can't claim that property and the one you're actually living in. But let's say your rental property, your old home was in Toronto or very close to it, and therefore very high appreciation rate, and you moved, oh, I don't know, up to Barrie, where the prices, although high or not nearly as high as in Toronto area, you'd be far better off to shelter the gain for another 4 years on the Toronto property. So if it's called a section 45(2) deduction, I'll just put that in the chat. 2 deduction, which allows you to extend the principal residence exemption. Okay, so the next one is financing charges. This is often overlooked as well. If you incur things like mortgage insurance or finder fees for your mortgage, this charge is deductible over typically the term of your mortgage. So that can be a significant savings as well when that's factored in. This one is fairly new. People are used to have a home business or used to home office expenses, but there was some controversy over whether you could claim home office expenses if your business was strictly a rental business. Within the last couple of years, there were some court cases where the taxpayer won one, which is too rare for my taste. And now they're definitely allowed, subject to a couple of constraints that we'll talk about. So you can deduct things like cell phone and internet and not prorate them. And things like rent or mortgage interest, insurance, property taxes, repairs, and utilities. Which are prorated typically as a ratio of the square footage of your office as a fraction of the total square footage of your home. So let's just say your home was 2,000 square feet and your office was 200 square feet, keep the math easy, then you get to write off 10% of all those types of expenses against your rental income. So insurance, it's definitely something you're going to need to protect yourself against things like fire or severe vandalism. Just be aware, if you haven't already found this out, it's often more expensive than that which is applicable to your personal home. So many investors start off their journey with a HELOC or a line of credit to finance their purchases. That interest, of course, is deductible, provided you're using it to earn income, which rental properties, of course, would be. Professional fees, so the fees that you you pay to have your tax return prepared are typically deductible. Legal fees on the acquisition of the property typically are not deductible in the year. They're just added to the cost of the property. Something that a lot of people get wrong, but it makes very little difference on most people's taxes. So it's not a huge area of concern, but technically it is wrong to write off your legal fees on buying a property in the year that you bought it. So mortgage interest is deductible. Of course, we're talking about interest and not the principal. Mortgage payments, as I'm sure everyone is aware, consists of both interest and principal. and the interest is the deductible portion of it. The breakdown between those two can typically be found on your annual mortgage statement you receive at the beginning of the following year. By the way, if we get kicked out from Zoom, you can just log in again using the same link and we'll be all set. So property management fees, as I said earlier, I do recommend that you have someone else manage the property for you as quickly as you can get that done so that you can focus on other things. Sometimes there's a commission that you'll pay to a realtor or other person such as the property manager to find a tenant. And these are something you can deduct, but like everything else, you want to make sure you get an invoice from them for that service. Property taxes and utilities are often missed in the year of acquisition or sale because of the transition of ownership. These adjustments are typically listed by the lawyers in a document that's literally called Statement of Adjustments. So if it's a single family home, these aren't going to be large sums, but it's certainly something that you have to pay. You might as well deduct. And of course, repairs. The only tricky part with repairs is there are times when what you think is an expense, for instance, putting in a new roof, it's actually required to be capitalized, which means it's written off over time, as opposed to expensed in the year that the expenditure was incurred. That will be the topic of a future presentation, given that it can get quite complicated. So fix and flip businesses have many of the same expenses that are available, but some of those ones that I just mentioned that have to be capitalized and written off over a longer term become current expenses. And that just means you can write it off in the year that you spent the money. So this would be things like broker's fees, real estate commissions, land transfer taxes. In this case, you do get to write off those legal fees right away. And if there's any penalties for breaking your mortgage early, that sort of thing. And renovations, like you put on a deck. And title insurance. Okay, so now this is the end of the first section. So if anyone has some questions, please unmute yourself or type it in the chat and we'll go from there.
Hi, Michael. It's Andrew. Quick question in regards to fix and flip. What is considered the time frame for it to be considered a flip? Or what is the definition of a flip? So as an example, if I purchase a property, renovated it extensively, and then was planning to flip it, but decided to put in a short-term rental pool for 6 months and then sell it all within a year period, would that be considered a fix and flip?
I would say yes, in all likelihood. Again, this is an area that's quite complicated, and CRA lists a whole bunch of factors getting to primary intent, secondary intent, and so on. Basically, because they're just fun this way, they'll list, say, 10 factors. And if 9 factors go one way in your favor, they'll say the last factor is the most important. But if it's the reverse, where that same factor that's the most important is in your favor, they say, well, it's just one of many factors. So you can't win with these guys. But basically, it comes down to your intent when you originally bought the property. You're allowed to change it if there's a good reason. So let's say you want capital gains treatment on the sale of it. It's a rental property. You're setting it up, and then you find out that your mom's sick and you got to move across the country to look after her, and you can't manage it remotely, so you sell it 3 months after you bought it. Well, that's going to look like a flip, the CRA. But you have, in this case, a very good reason for changing your plan. So that's where things can get decided, is based on the original intent. It's always tricky to do that, but it's certainly possible to have that work out in your favor.
Thank
right.
you.
You're welcome. Any other questions at this time? Okay, I just want to mention that if you do have some more detailed questions or something you'd like to discuss one-on-one, you can just message George, our co-host, and he'll schedule a free 30-minute session. I have 2 hours available tomorrow and 2 hours available on Monday. And if neither of those times work, there's my email address, and it's, you know, all over everything you get. So just send me an email, if some of you have already done, and we'll set up a mutually convenient time. Okay, so the next section deals with record keeping. Paperwork may not be your favorite thing, but it's absolutely crucial to running your business properly and to avoid problems down the road, because sooner or later, CRA is going to ask questions, and the paperwork is how you give answers. Now, I see there's a question from Navjeet. I'll quickly address that. Depreciation, that's what I meant by the CCA. It's the tax term for depreciation, and it's done on what's called the declining balance method. So let's say you bought your rental property all in for $500,000. You get to write